Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Sipe & Associates. I want to begin, as I always do, by saying thank you for taking the time to listen, and thank you for your service. To me, to the government, the country, you don't hear it enough. You'll always hear it here. Ed Zurndorfer is with us once again. The guru is here as part of our ongoing mission to reach, teach, and serve you. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at Serving Those Who Serve. That's stwserve.com, and we will help you any way we can. As is our wont, we are following Ed's FedZone articles. To give us one more way to reach and teach. And don't forget, we have even one more way beyond that, and that is the weekly serving. Every week, we deliver the best of Ed, Jen Meyer, Benefits Ben, yours truly, right to your inbox, so don't miss out. See our subscription information on our YouTube page. If you're coming from Spotify, just head to stwserve.com. There'll be a pop-up. Just pop your email in there, and you will be in the know. It'll be coming to you every week. Okay, Ed, today we are digging into one of your big wheelhouse areas, which is taxation. And folks, this is one where you want to be sure to head over to the FedZone and read that article because it has some important tables. And if you didn't know, Ed has a tax practice and is an enrolled agent with the IRS. So, Ed, your article is entitled How the IRS Taxes CSRS and FERS Annuities. And our listeners may very well be thinking, what's the big deal here? I get my annuity, I pay taxes on it. That's it, right? And what you're saying is not so fast.
Well, I wish it was that simple, Dan, but as you know, it's not. I just want to make a plug again for the FedZone, that my FedZone columns, which come out once a week, every month, and the columns in March and early April, total of 6 columns, will be devoted strictly to federal retirement benefits and taxes. Yeah. The first column, which occurred in the first week of March, is entitled How the IRS Taxes CSRS and FERS Annuities. The second column, going to be coming out very shortly, will be entitled How Survivor Annuities Are Taxed. Mm-hmm. So it's very important that federal retirees who are receiving annuities understand how their annuity is taxed. And it's also important that employees, they're still working for the government, both CSRS and FERS employees, should understand how their annuities are going to be taxed once they retire. Very important, because I will tell you up front, Dan, ladies and gentlemen, not all of a CSRS annuity or FERS annuity or CSRS survivor annuity or FERS survivor annuity is not all of it is taxable. A part of it is not taxable.
Gotcha. Okay, so you open us up with some descriptions of the 5. And yes, folks, I did say 5 retirement plans. Okay. And how much they're all kicking in, and therefore how much is going to be contributed to a non-taxable portion. So why don't you take us through those?
Okay, Dan. There are 2 retirement systems covering federal employees in general, 2. One is the civil service retirement system, the older system.
Right.
And within a CSRS employee, when he or she retires, will be receiving what's called a CSRS annuity. A CSRS annuity, which is a guaranteed pension, classified really is called a defined benefit plan. CSRS employees, like I was, contribute every 2 weeks 7% of their paycheck into the CSRS Retirement Disability Fund. That is their contribution. The agency that they work for contributes a heck of a lot more on their behalf. And once that money goes into the CSRS Retirement Fund on behalf of the employee, it's accruing earnings, interest, dividends, and build up over time. So the 7% that the employee puts in is put in with after-tax dollars. It's not pre-tax.
Gotcha.
The employee, when he or she retires and gets the CS annuity, will receive their contribution back, the 7%. And we're going to talk about how they get it back. But what you got to keep in mind is that 7% they put in, which was put in with after-tax dollars, is not going to be taxed again when it's taken when they receive it as part of the annuity. So that portion of their monthly payment is not taxable. Then we have a subset of CSRS called FERS offset. FERS offset, again, the rules regarding when they can retire, employees, and so on. The calculation of CSRS annuity is identical to a pure CSRS employee, except for one difference, that a FERS offset employee contributes to Social Security, unlike a CSRS employee. The CSRS offset employee contributes to the CSRS Retirement Disability Fund and contributes 0.8%, that's 0.008 of their after-tax salary into the CSRS Retirement Disability Fund. Now, why is it 0.8? Like I said a few moments ago, CSRS employees contribute 7% of their paycheck into the CSRS Retirement Disability Fund. A FERS offset employee is covered by Social Security. They have to pay what's called the FICA tax, the Federal Insurance Contribution Act, which is equal to how much of their pay? 6.2%.
Gotcha.
It's called the FICA tax. So if you add 6.2% and 0.8%, that's how you come up with the 7%. That's how it's broken down. Simple math. So the 0.8%, once again, is contributed after tax dollars, and the FERS offset employee will get back the 0.8% contributions they made during their years they worked as a FERS offset employee. They also worked at some time as a CSRS employee. So they're going to get back to that 7% as part of their monthly annuity. And once again, the 7% portion, the 0.8% portion they're getting back will not be taxed again. So that's two. Now we got two systems. Now let's move on to FERS, because FERS can be broken down to three systems. One I call the pure FERS. Those employees who work under the Federal Employees Retirement System, generally hired sometime after December 31st, 1983. They're called FERS employees. And if they were hired anytime before January 1st, 2013, they are contributing every 2 weeks 0.8% of their paycheck into the FERS Retirement Disability Fund, once again, on an after-tax basis, not pre-tax. They get back their 0.8% over the years when they are retired based on their life expectancy. Again, that 0.8% they're getting back as part of the monthly annuity was already taxed, so it's not going to be taxed again. So a small portion of their paycheck, of their annuity check is not taxable. Next category of FERS, and these are for FERS employees hired anytime during the year 2013. They are called FERS Revised Annuity Employees, FERS RAE, R-A-E. They contributed more to the FERS Retirement Disability Fund. How much more? 3.1% of their paycheck goes into the FERS Retirement Disability Fund. And again, on an after-tax basis, identical to the FERS employee, except they're putting more money in. They get their money back, their contributions over the years. And they're not paying tax on the money that they contributed over the years to the FERS Retirement Disability Fund. And finally, we have the third category of FERS, those employees hired after December 31st, 2013. Those are called FERS FRAE, F-R-A-E. You know what that stands for, Dan?
Further revised?
Further revised new employees. And they're contributing 4.4% of their paycheck into the FERS Retirement Disability Fund, again, on an after-tax basis. So there are your 5 categories.
Okay. And as your article goes forward, you open us up with some rules and some nomenclature that folks should know about. First up is the annuity statement. What do we have there?
All right, so we have to make sure we're clear on all the terms here. When you're first retired from federal service, you might be overwhelmed about all this retirement stuff that you're going to be getting. So we're going to be talking today strictly about the CSRS or FERS annuity. And OPM will issue what's called an annuity statement when you're first retired, and the statement that an employee, a recently retired employee, gets from OPM shows various terms, and one is the annuity statement. Okay, the annuity statement shows the annuity starting date.
Mhm.
What is when does your retirement become effective?
Mhm.
The gross monthly rate of the annuity statement, of the benefit, the gross monthly. When you're first retired, what is going to be your gross monthly amount? Okay,
Gotcha.
and also this is important. On that annuity statement, OPM tells the employee, what did the employee contribute in case of a CSRS or CSRS offset employee? What were their total contributions during their life, during their years of service into the CSRS Retirement Disability Fund? This is their contributions. OPM has kept track of it. And the same thing for FERS employees. What did they contribute to the FERS Retirement Disability Fund from their salary all the years they worked? Give an example. I worked 32 years for the federal government under CSRS. I contributed about $110,000 into the CSRS Retirement Disability Fund. That came off from my salary on an after-tax basis. And where is that reported? Well, it was on my annuity statement. I retired 17 years ago. I don't know where my annuity statement is, but I will tell you that OPM tells me every year what I had contributed, where. Every January, I get what's called a CSA, which stands for Civil Servant Annuitant 1099-R. And one of the boxes on that 1099-R, CSA 1099-R, it says contributions, total contributions that I made to the CSRS Retirement Disability Fund. Now, I will tell our listeners that box is very important, because it is possible that OPM may not tell you what the taxable portion of your annuity is. I'll get into that here in a few moments. But please note that OPM will always tell you what you contributed all those years as a CSRS or FERS employee. Okay?
Okay.
And I just want to say that those contributions that the employee made to the years represents the employee's cost in their retirement. That is what they paid for their retirement, their contribution.
Gotcha.
Okay.
Gotcha. And then, okay, so your next term up is gross monthly rate.
Okay. The gross monthly rate is the amount that a recently retired employee will receive after any adjustments, any adjustment. Now, when I say adjustment, we're talking about deductions from the gross amount.
Mm-hmm.
And I'm not talking about taxes, Dan. I'm not talking about health insurance premiums or dental or vision insurance or life insurance premiums. Probably the biggest adjustment that is made to a retired employee's starting gross annuity is the cost to give a survivor annuity. An employee retires, can elect to have one person, only one person, to receive what's called a survivor annuity. What's a survivor annuity? It is a percentage anywhere. In case of a FERS employee, it could be 25% survivor annuity or 50%. But the point is that the annuitant has to pay to give a survivor annuity, and how they pay for it? Through a reduction to their annuity. For example, FERS employee just retired, and they retired on December 31st, 2022. And their starting FERS annuity is $40,000 a year. They elected to give their spouse the maximum survivor benefit of 50%. So it cost the annuitant 10% of their annuity every year. So what's 10% of 40,000? 4,000.
Yep.
So the recently retired employees' gross annuity, FERS annuity, is 40,000 less 4,000, which is $36,000. Before I go on, Dan, I know I do this every time, but I have to make a plug for one of our webinars.
Plug away.
Very, very important. We hold a webinar every other month, not every month, entitled Understanding Survivor Benefits.
Yep.
And our next one, I believe, is on April the 4th. Next one will be after that, will be in June. But the point is, we talk about all types of survivor benefits. And we spend quite a lot of time on explaining the mechanics of a survivor annuity. And it's very important for employees to understand what if they were to pass away, whether it's in service before they make it to retirement, or if they die after they retire from federal service, what survivor benefits are available to loved ones. Please attend a survivor benefits webinar.
Sure.
Okay.
Gotcha. Okay, so as you press forward, you move directly from the gross monthly rate to the annuitant cost in the CSRS retirement, and also recovering an annuitant cost in retirement tax-free. So let's talk us through those.
Okay. So I was explaining what the employees, whether CSRS, FERS Offset, FERS, FERS Ray, FERS, are contributing every 2 weeks.
Right.
I gave the approximate amount. I gave the amounts. What percentage of their paycheck is being contributing every 2 weeks? Because those deductions are being made with are being deducted with after tax dollars, not pre-tax.
Mm-hmm.
Those contributions represent the employee's cost in their respective retirement plan. I'm going to give an example, make it a little bit easier for individuals to understand. Let's take an IRA, a traditional IRA. Everybody thinks about IRAs that the contributions that they make will result in a tax deduction. You look on your federal tax return, it says as an adjustment to income, IRA deduction. Well, that was the case. Every IRA traditional IRA contribution that individuals made between 1974 and 1986 was in fact deductible. It resulted the $2,000 or so you put into the IRA resulted in a $2,000 adjustment income, a tax deduction.
Mm-hmm.
Well, starting in 1986, Congress changed the rules, and this affected, by the way, most federal employees, that if one is covered by a pension plan like CSRS or FERS, and your income's too high, you can contribute to the IRA, but the contributions that you make will not result in any tax savings. You put the money in, you make your $2,000 contribution with after-tax dollars. Because the $2,000 contribution that you made was with after-tax dollars, the $2,000 represents your cost in the IRA. Meaning what? That when you take the money out of the IRA somewhere down the line after age 59 and a half, that $2,000 contribution you made will not be taxed again. You're only going to be paying tax on the accrued earnings in the IRA. Well, the same thing here in the case of your contributions that you're making to CSRS retirement or FERS retirement disability fund. Because the contributions you're making to the fund every 2 weeks is with after-tax dollars, you're going to get the money back. You won't pay tax again on the same money. And those total contributions that you made, like I explained a few moments ago, all the money you contributed to the CSRS or FERS retirement and retirement disability fund represents your costs in the plan. Like myself, I contributed about $110,000 into the CSRS retirement disability fund during my 32 plus years of service.
Sure.
I'm getting back the $110,000 as part of my monthly annuity, but not that portion I'm getting back each month is not taxed again.
Gotcha.
So the $110,000 represents my cost in the CSRS retirement and disability fund.
Makes sense. And then you take us through something that you call the simplified rule worksheet. So folks, strap in because simplified is a relative term. So, and be sure to head over to the Fed Zone and take a look at that article as you follow around. So, Ed, walk us through that simplified rule worksheet.
Okay, Dan, I in order to do this, I have to give you and our listeners a little history lesson here. It's very important that people that people understand, can appreciate what has happened over the years in terms of federal employees retiring, how they got their costs back in the plan.
Yeah.
Before July 2nd, 1986, when a federal employee retired, believe me, in those days, it was all CSRS employees. There was no FERS back in those days.
Sure.
The way IRS taxed a CSRS annuity is, they said, IRS, that during the first 3 years of your retirement, you will get back all of your contributions during the first 3 years. They'll pay it all back to you. Now, this is interesting. Now, I was in the government those days. I remember those days. And here's how it worked. Let's say an individual during their 30 plus years in the government had contributed a total of $90,000 into the CSRS Retirement Disability Fund.
Mm-hmm.
They retire. What is their CSRS starting annuity? $30,000 a year.
Gotcha.
So over 3 years, they're getting $90,000 a year, or a total of $90,000. That's exactly matches what they contributed to the CSRS Retirement Disability Fund. What does that mean? It means that the CSRS annuitant, during the first 3 years of his or her retirement, didn't have to pay any taxes on it because they got their costs back. But Dan, let me ask you a question. If I said to you that for the next 3 years, you don't have to pay tax on anything, you're getting a 3-year tax, you're getting a 3-year tax freebie, how would you feel?
I'd feel good, Ed.
Of course you would.
Yep.
Well, that 3-year simplified 3-year rule, IRS decided that is not a good idea. Why should we give annuitants a 3-year tax holiday? And Congress agreed with them. And Congress said, you know, it's a better idea that if the annuitant is going to get their costs back, let's spread it out over their life expectancy. Don't give it all back in 3 years. Just take their life expectancy and boom, they will be able to get their money back during their expected life expectancy, whether it's 25 years or 30 years.
Sure.
And IRS said, yeah. As I said, I was in the government those days. And what IRS said was effective. Anybody who retires after July 1st, 1986, you will no longer have the simplified rule as the method of determining how much of your annuity is taxable. I remember vividly. It was like February, around this time, February, March, 1986. What is that? About 37 years ago?
Mm-hmm.
Dan, there was a mass exodus out the government because a lot of individuals who were eligible to retire said, I got to get out of here before July 2nd because I want to take advantage of that 3-year rule. Well, IRS had to go to the drawing board to come up with something that would spread the contributions that the annuitant put into the retirement system, and to spread it out over their life expectancy. And they came up with something called the general rule. Now, the general rule involved actuarial tables that no one, and I would dare say even the IRS, understood. It was a disaster. It lasted 10 years. And Congress insisted the IRS come up with something that is more easier to understand. And that's where they came up with this so-called simplified rule. So anybody retiring after November 18th, 1996, that includes myself, was subject to the simplified rule. And it's all described in IRS publication 721. It's explained very well. You can download it from www.irs.gov. And I reproduced in this article I wrote, how the IRS taxes CS from FERS Annuity, all the relevant tables and the worksheet. It is really not hard to understand. Essentially, the way it works is that the individual retires, and based on what age they retire, and if they're giving a survivor annuity, let's say to a spouse, the age of the spouse when at the time that the employee retires, and based on their combined ages, they come up with a joint life expectancy, or in the case of not giving a single life expectancy, and they divide that life expectancy factor into the amount of money that the cost that the employee's cost in the plan, like I described a few moments ago, and that is the amount of their contributions they're getting back each month. Let's do an example here. Myself. Okay. So I put $110,000 into the CSRS Retirement Disability Fund. When I got my first annuity check, I was 55 years old. Giving a survivor annuity to my wife, she was 51 years old that year. Combine our ages, 55 plus 51 is 106. In this IRS publication 721, there's two tables. Table one is for individuals giving no survivor annuity. That's a single life expectancy. And table two is for individuals who are giving a survivor annuity. So that would be me. So the table says if your combined ages are less than 110, like ours is, 55 plus 51 is 106. Your joint life expectancy is 410. So you take $110,000, I'm doing it now, divide it by, 1 second here. Take 110,000.
Yep.
Divided by 410. Comes out to be $268.29, 268.29. That's the amount that I'm getting back each month of my $110,000, which has already been taxed. So that portion of my monthly annuity is not taxable. If you take 12 months, because we get 12 annuity checks per month, times $268.29, you come up with $3,220. So each year, $3,220 of my gross annuity is not taxable.
Gotcha.
Okay. A couple of things I want to point out, that even though I get COLAs, cost of living adjustments, most years I get them, my gross annuity goes up, but the amount that I'm getting back tax-free doesn't change. It stays the same. That is, each month, $268.29, or each year, $3,220 each month. So, Dan, it's really not as bad as it appears. It really isn't. Okay.
No,
And
I got you. I'm tracking.
And I have an example. In that helps individual understand it in the column I wrote.
Yes, you do, Donald.
Donald, it's very easy to follow the example. I encourage individuals to read that example. You'll have a better idea. It's very hard to understand everything when I'm just describing it, but it's all there. I have all the worksheets. Everything is there. It's easy to follow. So I encourage individuals to please read that column, which occurred. And the column came out in the first week of March 2023.
Yep.
I want to just say a couple more things here about OPM in terms of they're the ones who issue the CSA 1099-R.
Mm-hmm.
On the CSA 1099-R that annuitants get every January,
Mm-hmm.
showing what their amount of their annuity was in the previous year. On the CSA 1099-R, as I said, it tells you what your contributions were when you were working to your respective retirement system. It shows the gross annuity in one box and shows the taxable annuity. OPM does the calculation for you. They use the simplified rule to determine the amount of your gross annuity that's taxable. There's a box that says taxable gross distribution, and then it has the taxable distribution. So OPM is doing the work for you every year. You don't have to go through this worksheet. You don't have to worry. I do want to say that if you do your own taxes and use software like TurboTax,
sure,
there is a worksheet on TurboTax for the simplified rule. You can confirm OPM's number. It's not that hard. All you have to do, just read my columns. You'll see, because I have a copy of the worksheet from IRS publication 721. You can just follow along. It's really not that hard.
Gotcha.
But again, Dan, OPM does the calculation. OPM didn't always do this calculation. Before 2002, OPM, when they issued their CSA 1099-Rs to annuitants, they put on the CSA 1099-R the gross distribution, and in the box that said taxable distribution, you know what they put?
Unknown.
The word unknown. You know, Dan, as an accountant, when you see on a 1099-R in the box that says, and this could be for an IRA, could be for pension, anything, in the box that says taxable distribution, when you see the word unknown, as an accountant, you know what that does to you?
I'm going to bet you don't like it.
Your stomach is starting to turn. You have sweat going down your brow.
Oh, wow. You really don't like it.
And you know what the reason is? You know what the reason is? You're going to have to find out. You're going to have to ask the question to your client. Can you help me find out why it says unknown?
Ooh, ouch.
You're sweating it.
Gotcha.
Because you're going to hear, I just had no idea. Unfortunately, I have run across clients. I get new clients all the time who did, in fact, retire before 2002. They're still got, thank goodness, they retired, over 20 years ago. They're healthy. They're enjoying their retirement. And when they went to previous accountants to get their taxes done, and the accountant saw gross distribution, whatever amount it was, 40,000, 50,000, 60,000. And when they saw that box unknown, you know what the accountants did?
They didn't research it.
Yeah. And so what did they put as instead of unknown? You can't put unknown on your tax return.
Oh, I'm afraid they put 0.
No, they put the full amount, the gross distribution.
Okay.
Meaning that the annuitant overpaid his taxes all those years.
Gotcha.
Not very good.
Right.
Now, had the accountant done his or her homework, they would have looked up the simplified rule. They saw the employee's contributions on the CSA 1099-R, and themselves, they could have worked up what the taxable portion is.
Gotcha.
But many accountants didn't do that. They're lazy. I cannot tell you
Oof.
the number of new clients I've gotten over the last couple of years who went to these accountants, and their accountant says, I can't help you. I have to assume it's all taxable. And they got frustrated with them. You can do better than that. And they got my name.
Well, thank goodness they ended up with you.
And I said, I can, I'll be happy to do your taxes, but you realize that you overpaid your taxes over the last X number of years. They said, well, can we get the money back? I said, well, you're going to have to amend your return. And they said, well, I can go back all those years. Nope. Can't go back all those years. There's a statute of limitations. When you want to amend your federal and state taxes and you're due a refund because you overpaid your taxes, you can only go back 3 years. That's the statute of limitations.
Gotcha.
So
Woo.
I tell you, Dan, taxes many times are not fun, but I'm hoping that if federal employees are paying good money and going to accountants, that the accountants are fully aware of these rules and regulations when it comes to taxation of CSRS and FERS annuities. Very important.
We can only hope. We can only hope. Wow, Ed, this is a lot. So, I'm gonna ask a very leading question here. Is there something you can recommend for folks who may want to learn more about all this stuff? Any suggestions you might have?
Dan, once again, I'm going to ask for permission to make a plug.
Plug away, brother.
For one of our webinars.
Yep.
And we hold this webinar every month. It's entitled Taxation of Federal Retirement Benefits.
Yep.
It's held every month. In fact, I believe, if anybody's listening right now, our next webinar will be held tomorrow, March 15th. And as I say, if you can't attend it tomorrow, it's held in April, in May, June, every month. All you have to do is sign up for it. You can attend as many times as you want. Just a bit of trivia here, Dan. March 15th, which is tomorrow, used to be the filing deadline.
Oh, interesting.
Yeah, you filed your individual taxes and your deadline was March 15th, not April 15th. When was that changed? What was that changed? Dan, maybe you were alive, maybe you weren't. I was too young to do taxes. It was 1954.
That was just a pinch before me, Ed.
I was 3 years old, so I didn't understand taxes back then. But now it's April 15th. So, but the point is, once again, ladies and gentlemen, please understand that this is not easy. And we go through this during our Taxes of Federal Retirement Benefits webinar every month. Please attend as many times as you want and spread the word.
Absolutely. Great tip there, Ed. Ed, can't thank you enough. It's always special when we do this. It's great what you bring that helps us and how we can help the federal community. Folks, that is a wrap. We will see you next podcast. We are Serving This to Serve. Be sure to subscribe to this podcast on our YouTube channel or Spotify. Remember to share it with your friends and strangers. Check us out on Twitter and LinkedIn. Do not forget those live webinars every single month and every single week. We've got them going at the SWS website, that scwserve.com. You'll see the blue webinar button. Touch it, it turns red. Click it, takes you to the whole menu. Guru comes to you. Reach you where you are, teach where you are, serve you where you are. Sign up for one, sign up for all. Be sure to read Ed every week in the Fed Zone, fed-zone.com, and sign up for the weekly serving so it's delivered to you once a week. So in closing, for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, signing off as I always do by saying good luck, Godspeed, and above all, remember, it's your FedLife. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.